My name is Michael Levy. I'm a co-director of the PASS program. Before you watch this video excerpt, I'd like to tell you a little bit about the CFE Management Accounting Technical Review course. This course provides a thorough technical review of all of the major management accounting topics that can conceivably come up on the CFE. The course also includes a take-up of 4 mini cases where you'll have the opportunity to apply your management accounting technical knowledge to case scenarios. The following video provides an example of a review of one of the many topics that PASS will be covering in this course. Tonight, we're going to be working on one very important topic, and that is contribution margin analysis. As you're all probably aware, or most of you are probably aware, contribution margin analysis is defined as sales minus variable costs. And I think everybody knows what variable costs are. Variable costs are the sorts of costs that vary with sales. That if sales go up by 10%, the variable cost goes up by 10%. As opposed to fixed costs, which are fixed. They stay the same regardless of whether sales go up or not. So contribution margin equals sales minus variable costs. Now, contribution margin analysis can be used for a number of applications. To appraise alternatives that arise with respect to price reductions or special discounts, a company's trying to figure out, should they reduce their price, should they offer a special discount? Contribution margin can be a useful technique to use to make that decision. To determine how to utilize a given set of resources most profitably by determining which products make the greatest contribution to profit. You have a situation where you have a particular resource that is scarce, you have a limited amount of labor or a limited amount of material that you can obtain, and you want to focus on those profits that will allow you to maximize profitability. Contribution margin will be very useful. Another very common application you're all familiar with is break-even analysis. D would be determining whether to accept a special order. You have a big order coming in and somebody wants to pay a lot less than you would normally charge, say because it's a large order. Contribution margin may be helpful in making that decision as to whether to give a special price to that special order. Another popular use of this technique is to decide whether to make or buy a product. Another term that's often used in exams is outsource versus produce internally. Outsource versus produce internally is the same thing as buying versus making. Outsourcing is the same thing as buying. Producing internally is the same thing as making. Finally, to determine which product to push, which product to de-emphasize, and which product to drop completely, examining the contribution margins of each of the products will help make these types of decisions. So at the end of the day, guys, the testing of contribution margin analysis on the CFE, quite popular. At the end of the day, there are various scenarios we just talked about a moment ago where contribution margin can be used. And because it has so many uses that lend themselves to cases, very, very popularly tested in cases, among the most popularly tested of management accounting topics on the CFE. Right from the first CFE, contribution margin was tested. So again, probably the most popular topic we're going to be dealing with in this course. So I'd like to start by talking about contribution margin in the context of appraising alternatives with respect to a price reduction. We said earlier that one of the uses of contribution margin is to determine whether to reduce prices. So let's take a look. Briefcase Inc. is under a great deal of pressure to reduce the price for its Model A briefcase. Its current price is $100, and it's considered reducing the price to $77 to undercut the competition. Now, the total cost per unit associated with producing and selling the Model B briefcase, I've given you that right here. As you can see, labor is all variable, material is all variable in this example. I've given you a breakdown of fixed versus variable overhead. The variable overhead is $10. And I've given you a breakdown of selling expenses in terms of fixed versus variable. Variable selling expenses are $15. So the total cost, including both variable and fixed costs, are $88. We'll see in a moment what the total variable costs are. Let's assume that none of the fixed costs relate specifically to the Model A briefcase. So at the end of the day, the company has a number of fixed costs that they're incurring, say, in their plant. but none of them directly relate to producing the Model A briefcase. They just relate to running the plant overall. And the fixed costs that you see here are just fixed costs that were allocated to the Model A briefcase. But there's no incremental fixed cost relating to producing the Model A briefcase. If we stop producing the Model A briefcase, total fixed costs would remain the same. So how can we use contribution margin to help make the decision as to whether to reduce the price to $77? So the first thing I'd want to know is the total variable cost. Given the total variable cost relating to the production and sale of the Model A briefcase are only $75, as I mentioned a moment ago, the same fixed costs will be incurred regardless of whether the Model A is produced or not, because none of the fixed costs relate specifically to the Model A briefcase. You could argue on that basis that the company can afford to reduce its price to $77 if necessary, because they're going to end up recovering more than their incremental cost. Their only incremental costs are their variable costs because the fixed costs are totally unaffected. None of them relate specifically to this briefcase. So at the end of the day, you could make the argument the incremental costs are the variable costs, which are $75 a unit. If they can get a price of $77, they're making a small profit. And that's what I mean over here when I say, furthermore, the product will even make a minor contribution to profits of the firm. However, here comes a big however. That does not mean that in a case scenario, I would then say, okay, you can reduce your price, you'll still make a couple of dollars per unit, and you'll live happily ever after. I would not say that, because you have to consider the long run. In the long run, if every product just makes a small contribution margin, you may have a situation where all of the products combined in aggregate do not produce enough contribution margin in total, enough profit in total to cover all the fixed costs. So at the end of the day, the mere fact that I've made a small contribution margin doesn't necessarily mean in the long term that this price would be good enough. It could be that I still need to charge a higher price. At the end of the day, I need to generate enough total contribution margin from all of my products more than cover my fixed cost, all my fixed costs. Otherwise, overall, the company will not make a profit. And now the next topic I'd like to look at next, or let's call it the next application of contribution margin I'd like to look at, is deciding which products to emphasize when resources are in scarce supply. Now, this has come up more than once on the CP, so please listen very carefully. It's very, very mechanical, and I would be more than happy if it came up on my CP because it's very mechanical. So if you know how to do it, it's not very difficult. You have a division that produces 3 products, A, B, and C. The sales cost relationship for each of these products is as follows. As you can see, I've given you the sales price for each product. I've given you the variable cost for each product, and then sales minus variable cost gives you the contribution margin for each product. Similar to the last case, let's assume there are no fixed costs specifically associated with any of these products. So all the fixed costs just relate to running the whole factory. There are no specific fixed costs directly relating to product A, B, or C. Total fixed cost for the division per month, $10,000. Now, the division has available 1,800 machine hours per month. In the short term, they cannot increase their machine hours, okay? So that's a constraint. And right now, they're only able to obtain 130,000 kilograms per month of the material necessary to produce these 3 products. So they can only get so much material, and they can only get so many machine hours. I've also given you the time and material required to produce 1 unit of each of the products. So for example, product A takes 10 minutes to produce and consumes 20 kilograms of material. I've told you how many minutes product B and C take to produce, and I've told you how many kilograms of material they require. I've also given you the monthly demand for each of these products. There's a demand of 2,000 units for product A per month, 5,000 units of product B, and 1,500 units of product C. So what we're going to try to do is we're going to try to figure out what would be the best combination of products to produce. How much should we produce? Or let me rephrase that a little more clearly. how much should we produce of each product if we determine that we don't have sufficient capacity to fully meet demand? If we have enough capacity to fully meet demand, there's nothing to talk about. But let's say we don't have enough capacity to fully meet the demand that I just showed you here. So how much should we produce of each product if we are to maximize overall company profitability or overall divisional profitability? So the first thing we're going to need to do is produce a production schedule to figure out which of these two variables is in scarce supply. Is it machine hours that we don't have enough of to fully meet demand, or is it materials that we don't have enough of? The second thing we're going to look at is how many units should be produced of each product if we are to maximize divisional profitability. So that first question I said, how much should we produce of each product? We can only answer that question after we've done number one, after we figured out what is in scarce supply. So let's take a look, guys. Let's do question one first. This is what I meant by a production schedule. What we're going to do is we're going to ask ourselves, in how many machine minutes, I'm going to convert the hours into minutes. All I did to convert the hours into minutes was multiply by 60. So we were told we have 1,800 machine hours. I just multiplied by 60 and I got 108,000 minutes. We're going to try to figure out whether 108,000 minutes is enough to fully produce the full demand we have for each of product A, B, and C. Let's take a look, guys. For product A, we have a demand of 2,000 units, and we were told on the previous slide that each unit takes 10 minutes to produce, right? 10 minutes for product A, 15 minutes for product B, 20 for product C. So if I want to fully meet my demand for product A, there's 2,000 units in demand. Each unit takes 10 minutes. Basically, I'm going to need 20,000 minutes. Now, for product B, the demand for the previous slide was 5,000. In case anybody forgot, here's the 5,000 right here. So for product B, the demand is 5,000. Takes 15 minutes to produce each unit, so we're going to need 75,000 minutes. For product C, the demand is 1,500 units, and each unit takes 20 minutes to produce. That means 30,000 minutes in total. So to fully meet demand, we're going to need 125,000 minutes. But there's only 108,000 minutes available, 1,800 hours. Therefore, it looks like we don't have enough capacity. We're 17,000 minutes short. So machine hours are clearly in, or machine minutes, whatever you want to call it, is clearly in scarce supply. We don't have enough of it. Now let's take a look at materials. For materials, we know that for product A, if you just want to go back to the previous slide, we need 20 kilograms of material per unit, product B 10, and product C 25. So to fully meet demand for product A, we need 2,000 times 20 kilograms, which is 40,000 kilograms. For product B, 5,000 units demanded times 10 kilograms gives us 50,000. And for product C, 1,500 kilograms times, 1,500 units times 25 kilograms gives us 37,500. So to fully meet demand, we're going to need 127,500 kilograms. But the amount of kilograms available based on the previous slide is 130,000. So it looks like materials are not in scarce supply. We actually have excess capacity. We actually have 2,500 more kilograms than we require to fully meet demand. So we've now determined which of the two is in scarce supply. It's the machine minutes that is in scarce supply. Now, here's the most important principle you need to understand if you're going to produce the right quantity of each of these three products to maximize profitability. The important principle that you need to understand is that we're not going to produce the greatest number of that product that has the highest contribution margin per unit. What we're going to produce is the highest number of that product that has the highest contribution margin per whatever is in scarce supply. So in this case, because machine minutes or machine hours are in scarce supply, what we're going to do is we are going to try to produce the greatest number of that product which has the greatest contribution margin per minute. Had materials been in scarce supply, we would have tried to produce the greatest number of that product that had the highest contribution margin per kilogram. The reason I'm focusing on highest contribution margin per minute is because it's the machine minutes or machine hours that are in scarce supply. So let's take a look now at the contribution margin of each product per minute. Product A, from I believe a couple of slides ago, was $6 contribution margin per unit. It takes 10 minutes to produce each unit of product A. So the contribution margin per unit for product A, 0.6 or 60 cents, right? Now, product B has a contribution margin of 10. We saw that a couple of slides ago. You should have that in your notes in front of you. It takes 15 minutes to produce each unit. 10 over 15 gives us a contribution margin per minute of 0.67. Finally, product C has a measly contribution margin of only $2, and it takes 20 minutes to produce. So all it gives us is a 0.1 or a 10-cent contribution margin per minute. So product B has the highest contribution margin per minute. The next highest is A. So B and A contribute the most per minute of machine time. Product C has the worst, only 0.1. It's much, much less than the others. So we're certainly going to want to first fully meet demand for product B. We'll use whatever excess capacity we have for product A. And then finally, whatever we have left over, we'll use for C. We'll give C the lowest priority. So let's take a look then, guys. So we start with product B. If we want to fully meet demand for product B, the full demand for product B is 5,000 units. Product B takes 15 minutes to produce each unit. So to fully meet demand for product B, I need 75,000 minutes. So at the end of the day, we've got 108,000 minutes to play with. That's 1,800 hours of capacity. If I use up 75,000 minutes for product B, we're left with 33,000 minutes. Now, we then move on to product A, which has the second best contribution margin per minute. To fully meet the demand for product A, I need 2,000 units times 10 minutes per unit. Each unit of product A requires 10 minutes to produce. So I'm going to need 20,000 minutes to fully meet my demand for product A. I've got 33,000 minutes left over after producing product B. So if I use 20,000 of those 33,000 minutes left over to fully produce my full demand for product A, I'll have 13,000 minutes left for product C. 13,000 minutes is not sufficient to fully meet demand for product C. If you take the full demand for product C, right, if we go back to the previous slide, if you take the full demand for product C of 1,500 units and you multiply by 20 minutes, you're going to get more than 13,000 minutes. The bottom line is we don't have enough capacity to fully meet the demand for product C. So we try to produce as many units of product C as we can using our leftover minutes. We've got 13,000 minutes left over after we finish producing product A and B. Each unit of product C takes 20 minutes. So 13,000 times 20 minutes gives me 650 units. So at the end of the day, I have enough capacity to produce 650 units of product C. That'll consume 13,000 minutes. I've now used up all my minutes and I'm down to zero. So how do we maximize profitability? By fully meeting demand for A and B and only partially meeting demand for C, because C gives us the worst contribution margin per unit of scarce resource, in this case, per minute. Now, if we continue on to the next slide, on a real CP, it's quite likely that in addition to dealing with quants, when you're dealing with a scenario of what products to produce, when you've got scarce resources, You may also have to deal with qualitative factors. Usually on the CFE, almost always, when you're making a major business decision, usually there are qualitative factors too. So in real life, it may not be practical to produce things the way I just showed you here. It may not always be practical to do exactly 5,000 units of B, 2,000 of A, and 650 of C. For example, it may not be possible to sell 5,000 units of B and only 650 units of C if the products are interrelated. Let's say, for example, product B is tennis rackets. And let's say C is cans of tennis balls. And let's say when many people buy a new racket, they also want to buy balls. In that situation, it might not be possible to sell 5,000 tennis rackets, but then only sell 650 cans of balls. So sometimes there could be qualitative factors that prevent you from selling things in their most ideal situation. In other words, it may not be possible to meet this quantitative ideal based on qualitative constraints. Also keep in mind, and I believe this came up in one CFE, you can have an item that has a low contribution margin per unit of scarce resource, but if people don't buy that item, they won't buy the more profitable items. So you may want to maximize sales of that item so you can sell your more profitable items. In other words, I might sell printers and ink. Printers might have a poor contribution margin, but if I can sell lots of printers, hopefully I'll sell lots of ink. If that's the case, I'll want to sell a lot of printers, even if they have a low contribution margin, or even if they have a negative contribution margin, if they're helping me sell something else that will be very profitable. So you've got to consider qualitative factors too. The next topic I'd like to look at is break-even analysis. When would I use break-even analysis? Number one, I would use it to determine the viability of a new business. At the end of the day, somebody comes to you and says, I want to start up a new business. So you'd want to compare the break-even point with the expected levels of sales. If the guy says to you, I think I'll only be able to sell 60,000 units, and you need to sell 70,000 units to break even, at the end of the day, it may not make sense to start this business. Another situation, to determine the viability of new products or services for an existing business, you have somebody who comes to you and they say, I'm in the purple widget business, but I've always dreamt of selling gold widgets too. So I want to introduce a new product line called gold widgets. Unless they can sell enough gold widgets to break even, it doesn't make any sense to launch this new product line. If they need to sell 70,000 gold widgets to break even, but they only expect to be able to sell 60,000, it doesn't make sense to launch this new product line. Finally, the third one is a less obvious use of break-even, but it can come up. To determine whether a new fixed cost should be incurred. For example, you have a company that's considering starting up a new quality control department. And if we start up this quality control department, it's going to incur significant additional fixed costs. We're going to have to hire salaried quality control personnel. We'll have to rent space. Maybe we'll have to rent some machines, etc. So at the end of the day, we may end up increasing the fixed cost by X $100,000. We may need to compute whether the contribution margin from the increase in sales that we can generate from having better quality control will exceed the additional fixed cost. That will involve break even. In case you're wondering about this third example, I will demonstrate it very soon. Now, guys, keep in mind that break even can come up on an exam just as easily in a service organization as in a product situation. I just gave examples of selling a product, the widgets, but it can just as easily come up and it can be equally relevant in a service business. Now, one very important principle to keep in mind when we talk about break even. Keep in mind, guys, that in computing break even, you're always interested in long-term sales and not short-term sales. So at the end of the day, I don't care when I'm looking at somebody starting up a company, whether they're going to break even next year. Most companies, even if they're ultimately very successful, don't break even in their first year, maybe not even in their second year. What we're always interested in when we do break even is in the long term, will the company break even? So I would be interested, once the company gets its sales up to where they're expecting to get their sales in the long term, which could take 2 or 3 years, will they have sufficient sales to break even? That's what I care about, not whether they'll break even next year. I doubt very much Google broke even their first year, or Microsoft, or any of the big success stories. Now, break-even analysis. How do you calculate break-even? So you can calculate break-even in terms of units. How many units do I need to sell to break even? The way you would do that is by taking fixed cost divided by contribution margin per unit. You can also calculate break-even in terms of dollars by taking fixed cost divided by contribution margin percentage. Contribution margin percentage means contribution margin per unit over selling price per unit. So this equation tells me how many units do I need to sell to break even. This equation tells me how many dollars of sales do I need to make to break even. Let's take a very simple example just to make sure that everybody understands the concept. Company A is considering producing a new type of widget. Total variable costs for production of the widget are $8, and fixed costs per year are expected to be $8,000. The company plans to sell the product for $10 per unit. The president thinks the company can probably sell 5,000 units per year. Again, we're talking about now in the long term, once they reach their expected sales. And the president's concerned about whether that will be sufficient to break even. So how do we figure this out? We start off by calculating the contribution margin, the $10 sales price minus the $8 of variable cost. That gives us $2. We then take our total fixed cost of $8,000. We divide by our contribution margin per unit, and we come down to a break-even point of 4,000 units. The president said that he thinks the company can probably sell 5,000 units, so the company should be able to very easily break even because they only need to sell 4,000 units to break even. Now, on a CFE, this has not come up yet, but it's possible to get a case in which you have to deal with break-even calculation where there's more than one product. In order to calculate break-even, what you would need to do if you have more than one product is first calculate the weighted average contribution margin based on the expected breakdown of sales between the two products, based on what percentage of sales will be made up of each product. And then you would simply divide the fixed cost by the weighted average contribution margin to compute the break-even. And what I'm going to do now is I'm actually going to show you an example which is based on the problem section of your book or your binder. Following the lectures, you should see a whole bunch of problems. And one of the problems that deals with break-even has a situation where you're dealing with more than one product. And that's what I'm going to go over right now. I can't swear to you that this is the right page number in your particular binder or book, because there's different versions of the book and binder, so I may be off by a little bit, but if you go to the problem section, you will find the problem that I'm about to go over. Music Inc. is in the business of producing various musical instruments. The company is considering adding to its product line string instruments, which would include the guitar and the banjo. Don't ask me why I came up with the banjo, not the most common instrument. The price cost associated with producing each of these instruments, I have given you in each of these two columns right here. Now, here are a couple of very important points we need to keep in mind. The fixed costs relate directly to the production of banjos and guitars and are allocated between these two instruments. So these fixed costs that you see over here are not just general fixed costs to run the company. These are the fixed costs specifically relating to the production of banjos and guitars. And at the end of the day, we use the same machinery, etc. So we end up allocating the fixed costs between these two instruments. Now, the other point I just want to bring home is if you look at the fixed selling cost, what are the fixed selling, what do we have to say about that? Well, let's take a look. Salespeople are paid a salary plus commission. The fixed selling costs relate to the salary portion of the salespeople remuneration. Commission, of course, is variable because it's based on sales. All salespeople are involved in selling all of the company's product lines, and are not exclusively involved in selling banjos and guitars. So none of the fixed cost of sales relates directly to the selling of guitars and banjos. Salespeople sell all the products. So all we do is we take to come up with the fixed cost that we've allocated to guitars and banjos is simply an allocation based on some sort of formula. The company has a formula where they allocate the fixed selling costs, salaries of their salespeople to all of the different products that are sold, including guitars, banjos, and other products. And they've allocated $40,000 to guitars, $20,000 to banjos. Here I've given you guys the direct materials, direct labor, and variable overhead. I've also given you, as I said, fixed costs, which we talked about. And down here, we have the selling cost. As we mentioned earlier, you've got the commissions, and then the fixed cost being the salaries. Notice, guys, the commission is 10% on the guitars and 5% on the banjos. What I'm going to go over with you is question number 1. Question number 2, I will not go over with you because it's extremely unlikely to come up on an exam. It's an interesting question, but unlikely to come up on an exam. Question 1, on the other hand, could easily come up on an exam, so that's what I'd like to focus on. Question 2, I'll let you look at on your own. If guitars and banjos are expected to account for 80% and 20% of string instruments, respectively, what is the total number of string instruments the company needs to sell to break even? Remember I mentioned earlier that in order to do a break even when you have more than one product, you need to know the breakdown of sales for each product. So here I'm telling you what the breakdown is. 80% will be banjos, 80% will be guitars, 20% will be banjos. So let's take a look now at how we would figure out our break even. The first thing we would do is calculate the contribution margin for each of the 2 products, and that's pretty straightforward. The materials and direct labor were variable, so we're subtracting the cost. Then we also subtract the variable overhead, which was $6 for guitar, $10 for banjo. We also subtract the variable selling cost, in this case the commissions. The commission was 10% for guitars, 10% of 80 is $8, 5% for banjos, 5% of 60 is $3, and we come down to a contribution margin of $14 for the guitar, $4 for the banjo. The weighted average we calculate by taking 80% times the contribution margin for guitar plus 20% times the contribution margin for banjos, given that we're expecting an 80-20 split, and we end up with a weighted average contribution margin of $12. So to calculate my break even, what I would do is the following. I would take my total fixed cost, and then I would divide by my weighted average contribution margin of $12. So 360,000, and in case anybody's wondering where I'm getting the 360 from, all I did was I took these fixed costs right here. 250 plus 110 is 360. I ignored the salaries. I ignored these costs, the 40 plus the 20, because these are not related specifically to guitars and banjos. As you mentioned earlier, the salespeople sell all the instruments. So at the end of the day, even if we didn't sell guitars and banjos, the fixed selling costs would still stay the same. So they're not directly related to guitars or banjos, so I'm ignoring them. So I take my total $360,000 of fixed costs that relate specifically to guitars and banjos. I divide by my weighted average contribution margin of $12. My break-even point is $30,000. What that means is I need to sell a total of 30,000 string instruments, guitars plus banjos, in order to break even. Now, if I need to sell 30,000 string instruments, guitars plus banjos, can somebody tell me how many guitars and how many banjos we need to sell? We know we need 30,000 in total to break even. Can somebody tell me how many I would need to sell of each? Anybody? Excellent, excellent, very good. A number of you are getting it bang on. At the end of the day, based on our 80-20 split, I need to sell 24,000 guitars and 6,000 banjos. How did I get that? Many of you got it correct. I simply took my 30,000 total number of string instruments that I need to sell, and I multiplied by 80% to get the number of banjos. 80% of 30,000 is 24,000. I then took 20% times 30,000, and that gives me 6,000 banjos. So 80% of our sales are guitars. So 80% of 30,000 is 24,000. So we need to sell 24,000 guitars, and then we only need to sell 6,000 banjos based on 20% times 30,000. We hope you enjoyed watching this excerpt. If you'd be interested in seeing the remaining topics covered in this course, as well as a take of the mini cases, please feel free to register for this course. If you're not already on our website, please visit our website, passyourcpa.ca. When you get to the website, put your cursor over CFE module courses at the top of the screen, and then click on CFE Technical Review, and you'll be able to enter the course and register. If you have any questions, both I, Michael Levy, or my partner, Al Walfish, would be delighted to speak with you. We can both be reached either by email or by phone. We look forward to seeing you in this course.